Many homeowners overlook tax deductions that can help offset those costs. Whether you've recently bought your first home or you've owned one for years, here are 8 homeowner-related tax deductions worth talking to your tax professional about. Before you itemize deductions, compare the benefits to the IRS's standard deduction. For 2025, the standard deduction is $15,000 for individuals and $30,000 for married couples filing jointly. You can't itemize and take the standard deduction. You'll need to choose one. If the standard deduction lowers your taxable income more than itemizing would, it's likely the better option. If you or someone in your home has a disability, you may be able to deduct the cost of home improvements made for medical necessity. Qualifying upgrades include things like wheelchair ramps or widening doorways. These changes must be made to accommodate a medical condition and not just improve the home's value. Property tax rates vary widely depending on the state you live in. You can deduct up to $40,000 in state and local taxes, including property taxes, on your federal tax return. However, if your total property tax bill is low, it may not be worth itemizing over taking the standard deduction. Own more than one property? You can deduct property taxes on your second home or rental property as well, as long as your total deduction for state and local taxes doesn't exceed the $40,000 cap. This includes real estate taxes for vacation homes, investment properties, or even land. Mortgage interest is one of the most common tax deductions for homeowners. If you bought your home on or after December 17, 2017, you can deduct interest on the first $750,000 of mortgage debt, $375,000 if filing separately. If your mortgage is older than that, the limit increases to $1 million, $500,000 if filing separately. With today's high interest rates, this deduction could be a significant one. If you took out a home equity line of credit and used the money to buy, build, or improve your home, you might be able to deduct the interest. This is subject to the same total debt limit that applies to your main mortgage. The interest is only deductible if the funds went toward qualified improvements to your primary residence. Mortgage points are fees paid up front to lower your mortgage interest rate. If you paid points when you took out your loan, and they meet certain requirements, those points could be deductible. For instance, the practice of charging points must be common in the area where your loan originated, and the points must be calculated as a percentage of the mortgage. If you're self-employed and work from home, you may be able to deduct expenses related to your home office. The IRS requires that your office be used exclusively for business. There are 2 ways to calculate this deduction: a simplified method, which allows you to deduct $5 per square foot, up to 300 square feet, or a regular method that requires tracking actual expenses based on the percentage of your home used for business. Owning a home isn't cheap, but some of your expenses could help you reduce your tax bill. Knowing which deductions to consider could lead to meaningful savings. Before you file, talk to a tax professional to figure out which options make the most sense for your situation.